Welcome to this explainer. Okay, so we usually think of capital gains tax as the price of success, right? You sell an asset for a healthy profit, you pay tax. Simple. But what happens when things go accidentally, disastrously wrong? What if a fire literally burns your building to the ground, or a highly valuable painting is completely ruined? Today, we're diving into the deeply ironic world of UK tax rules that govern your assets when they are lost, destroyed, or damaged. Because yes, even in a disaster, the taxman is definitely watching.
Here is our roadmap for today. We're going to cover 1. The accidental disposal. 2. Total loss. 3. Replacing destroyed assets. 4. Partial reinvestment. 5. Partial damage. And lastly, 6. The restoration exception. Let's jump in.
Section 1. The accidental disposal. So, for capital gains tax purposes, a disposal isn't just a voluntary happy sale. It explicitly includes the loss or total destruction of an asset. And here's the kicker. Simply receiving an insurance payout or compensation for some damage actually counts as a disposal too. I know it sounds crazy. You didn't choose to sell it. But in the eyes of the tax system, a fully taxable event has just occurred.
Now, think of the rules as a giant decision tree. Right at the top, if your asset is lost or destroyed, the absolute first question we have to ask is, are there insurance proceeds? If there's no insurance, it's a pretty straightforward calculation. But if there is a payout, well, the path splits again based on whether you reinvest that money into a replacement. Basically, every single financial choice you make after a disaster completely changes your tax reality.
Section 2. What happens in a total loss? Let's walk through a real computation. Say Nadir purchased an asset for £15,000 and unfortunately is destroyed by a fire. Because she didn't have insurance, her only return is literally selling the scrap for £1,000. To figure out her tax position, we take that £1,000 in scrap proceeds and deduct her original £15,000 cost. This creates a standard allowable capital loss of £14,000, which she can then use to offset her other capital gains.
But what if Nadir actually had insurance? Well, there's a massive, incredibly important detail here regarding timing. For an insured loss, the disposal date is the exact date the insurance proceeds hit your account, not the day the asset actually burned down. Think about that for a second. If a fire happens in March, but the insurance company drags their feet and finally pays out in May, that simple shift in dates pushes the entire tax event into a completely different tax year. That could mean entirely different tax rates applying to your money.
Moving right along, Section 3, Replacing destroyed assets.
Okay, take Bill's scenario. He bought an asset for £25,000. It's destroyed. Between scrap value and his insurance payout, he receives £36,000. Now, instead of pocketing that cash and paying tax on the gain, Bill fully reinvests the entire $36,000 into a brand new $40,000 replacement asset. Because he reinvested absolutely everything, he gets to claim what's called replacement asset relief. It creates a no-gain, no-loss disposal. His tax liability is essentially deferred and rolled over into the base cost of his new replacement asset. It's a fantastic relief.
Section 4. Partial reinvestment. But what if you don't spend it all? Let's compare our paths. Full reinvestment means you spend all the proceeds, and your full gain is safely deferred. Awesome. But partial reinvestment? Say you find a cheaper replacement and decide to keep some of that insurance cash in your back pocket. Red alert. The moment you retain cash, part of your gain becomes immediately taxable.
So exactly how much is taxable right now? It comes down to a classic statutory trap known as the cash retained calculation. The amount chargeable today is the lower of two figures, your total gain or the amount of insurance money you didn't reinvest. You absolutely have to memorize this test. Any gain left over after that can be deferred, sure, but HMRC will immediately want a cut of that unspent cash.
Section 5, Partial damage.
Now, what if an asset isn't destroyed, just damaged? You get insurance money, but you decide not to fix it. This triggers what's called a part disposal. It's a three-step dance. Step 1, your insurance money counts as your deemed proceeds. Step 2, you obviously can't deduct the original cost of the whole asset against just a partial payout, so you have to apportion the cost using a special formula, A over A plus B. A is the insurance payout, and B is the leftover value of your damaged asset. Then, step 3, you calculate your final chargeable gain.
Let's see this part disposal math in action. It's wild. Sasha bought a painting for 10 grand. It gets damaged. She gets £30,000 in insurance, but decides to just leave the painting torn. Even torn up, it's still appraised at £25,000. So, deemed proceeds, $30,000. To find her allowable cost, we take her original £10,000 cost, multiplied by 30,000, divided by the total of 30 plus 25,000. That gives us an apportioned cost of just over £5,400. Subtract that from her proceeds, and bam, Sasha's hit with an immediate chargeable gain of over £24,000, all because she didn't fix it.
Which brings us to Section 6, the restoration exception.
So Sasha got a brutal tax bill, right? But there is a lifeline. And this is the magic number you need to burn into your memory. Greater than 95%. If you take your insurance proceeds and spend more than 95% of them on actual repair and restoration expenditure, you can elect to skip that painful part disposal treatment entirely.
Let's look at Anya. Her painting gets damaged, she gets £8,000 from insurance. But unlike Sasha, Anya actually spends £7,700 restoring the piece. That leaves only £300 unspent. Because she spent well over 95% of her proceeds, she dodges the part disposal. Instead, she uses a deferral. She simply takes those unspent proceeds and deducts them from her original cost. It lowers the painting's future base costs for whenever she eventually sells it down the line. It's an absolute game changer of a relief provision.
So we've navigated the destruction, the damage, and the very different paths of reinvestment. It all boils down to this. If a disaster strikes your assets tomorrow, are you prepared to calculate exactly how your reinvestment choices will trigger or defer your next tax bill? As we've seen today, these tax rules are incredibly specific, and the financial decisions you make in the direct aftermath of a disaster will absolutely dictate your tax reality. Thanks for joining me on this explainer, and I'll see you next time.